Hello, students. Now let's finalize the forecasted financial statement and comparative analysis. As we completed all these um, the models for the forecasting sales, right? So here now, once you found the one of the best fit for the sales back data and how your regression aligns, for me, maybe I can use this Holt Winters additive seasonal model or this Holt Winters multiplicative the seasonal model. If I the predict or forecast the seasonality will be gets wider, progressively wider, then maybe uh, I can use this the model. But otherwise, also I can use this Holt Winters additive seasonal model. Again, if your case is very the predictive in terms of the size of the seasonality or the fluctuations, then you can also use the time series regression model. But here, for me, I'm going to use the Holt Winters multiplicative model. So how to link? Just simply you can link from this model, right? Enter. Okay, then based on your own research, again, this is as forecasted on the regression model or the Holt Winters seasonal the models. It's just the average because all this the numbers is calculated based on the past patterns, the past the stage levels or the trend or seasonality, right? You cannot 100% guarantee the future the sales. So you do some research, and for me, I researches about some articles or reading the 10Ks and some interview from the earnings call transcripts, um, the CEO interviews or whatever, right? And then also the market analysis, the top-down analysis, the industry overview, competitive positioning, um, or economic outlook. I read a lot of articles, and then my decision is to apply a little lower cases. So 95% of this, also the 95%. Yeah, because this is the area you can put any number there as long as you can justify the rationale on the paper, right? So likewise, the cost of sales now, once you figure out this, the sales forecasted numbers for the forecasted the quarter, then also this is based on the research, right? You start from the actual the percentage you calculated, then you can make the projections increasing, decreasing, or increasing in the middle. Now it is decreasing. So any kind of other number you can put there, as long as you can explain. Again, as mentioned during the class, I'm not going to argue why 1.3%, why not 1.25%. I'm not going to argue, but I'm going to see your underlying logic or some trend. For me, here, for example, depreciation, the SG&A is slightly increasing trend, or R&D is very is increasing also, right? It's kind of a trend, right? Based on your own research, and then you describe this the logic behind the logic on the paper, okay? And then the balance sheet accounts also can be the link to the percentage of sales. But again, as we practice today, the property plant equipment is not linked to the sales, right? Instead, we make the trend here right? So you can link equal this trend so now you have the balance sheet account, the property plant equipment here, right? And other variables in the assumption, forecast assumption, for example, uh, the commercial paper or short-term debt or long-term debt, you also have some assumption, right? I put some increasing the short-term debt interest rate, annual interest rate, or long-term debt increasing based on my own assumption, right? Based on my research, the industry or the economy, maybe the inflation still ongoing. So I, I can justify this increasing the interest rate short term or long term in the near term, like 4 quarters still increasing. And then that will affect definitely the interest expense calculation as well, right? So that's why the older income statement is now linked here. The total net sales are linked from the uh, forecasting assumption table, and then everything now is linked the percentage as a percentage of the sales, right? And then the interest expense here in the forecasted quarter 1, 2, 3, 4. Here now we need to a little the more the be cautious to get this interest expense, because interest expense here is not the yearly basis, it's not annual interest rate, but the quarter interest rate, right? So here, for example, now how they link or how they find this the interest bearing the liabilities, short-term and long-term liability, is from the prior quarter, and then we link to the assumption part, right? For example, here, now how to calculate this? Equal, now minus, first, commercial paper here, right? Commercial paper, this commercial paper 3% now times what do we want to link, right here, commercial paper, right? So the prior quarter, right? And then plus, next is 4% now times, what is this account? A short-term debt. So here I have a short-term debt here, right? Short-term debt, and then move to the long-term debt, 5%. You can also find it is the representative, the effective interest rate in the 10K or 10Q times here interest-bearing term debt, right? Your company could have the term debt or commercial paper, or would not have the term debt in a short term, right? That's why you have to revise this the templates according to your the income statement or the balance sheet. So here now I link this. Then I cannot just simply, I need to make the parenthesis. This is the 1 year interest expense then, right? But the balance we used is the prior quarter, right? And then the interest expense you calculate is the current quarter. So we need to now divide it by, right, 4. So now we got this number, it's the interest expense. Then let's drag. This number will be changed. Why? We haven't found this commercial paper yet, right? Okay, then let's move to the balance sheet. How do you balance out between the total asset and total liabilities and equity? Again, as we discussed during the class, right? Deficiency or excess cash. So we use this commercial paper if the total asset is greater than total liability and equity, we will increase the commercial paper, right? Because the company increased the total asset for the period, for the quarter, then how to make up? Yeah, we issue the commercial paper, right? If your company doesn't have a commercial paper, you can just include commercial paper in your template as well, right? Here, we might use just the cash instead of marketable securities. But yeah, let's practice. It's marketable securities also one of their investment tool, right? And then we can use this marketable securities. For example, if they have more cash, then they invest the RP or MMF or investment of the CP of other companies or CDs, right? So they can use this marketable securities, almost the cash, right? So for example, the next here, next quarter, and the next the quarter of total liability and equity. So actually it's not, because I removed this part in the middle of the process of completing this balance, but you do not start here. That's why I recorded these video clips, but we'll go over again. Maybe the session 6 or session 7, I will emphasize this process. Okay, so here now total current liabilities we have, and then total liabilities now we have. Now this one should be starting from the total liabilities plus total shareholders equity. So that is a starting point. Now let's compare between these two, right? The total asset and total liabilities and equity, right? Here, oh, by the way, we have to get this prior balance first. Then now again, let's compare total asset and the total liabilities and equity. These two. Now which one is bigger than the other, right? You can remember this process in AFN for the long-term projections in the business strategy. So total asset 419 billion and 409 billion, right? So which one is bigger, right? The total asset is bigger, right? If the total asset is bigger, then we have to increase the commercial paper, right? Commercial paper. Now, first, what you have to do is to link this total asset, right, and the total liabilities and equity. We balance it first, right? We balance it out first, and then this number will be should be now the calculated, right? So how do we calculate this? Maybe we have to avoid circular error if you use this total asset, but yeah, let's carefully input this now minus total equity minus, and not total liability, but here total non-current liabilities, right? Then minus all the factors of the current liabilities except for the commercial paper. So now you got this commercial paper, right? So they increase the commercial paper or any short-term debt financing tool, right? Next is the same process. I think it is wrong. Again, equal. Okay, I need to change. Get this, the prior balance. again get the prior balance, and then this must be the total current asset plus total non-current asset. So okay, so let's get started from this number. Then okay, so which one is bigger now? Right, this quarter two, or the total asset or total liabilities. Total liabilities is bigger. Now is the time to revise this by balancing out first total asset and the total liabilities, right? So here, let's put this total asset minus. Now total non-current asset, now minus. We cannot use total current asset. Instead, we have to put its component of the current asset so that we can plug in. So now they're marketable securities because they have more asset. This is kind of excess cash, right? So now they have the marketable securities, the $58 billion, right? Then let's continue. So this is not the answer yet. Oh, first we have to start from the prior balance of the quarter, right? And then I think is this correct? Total current asset plus total non-current asset. So which one bigger? It's almost the same, but yeah, total current liabilities and shareholders' equity is bigger, right? Then now let's link this. Then because we already have this the same case, right? When you increase, so here we can just now drag to the right so that we have the marketable securities that increased by a little, right? A little more. And then next is also let's finalize. Equal and equal. Now this 4 times the repetition of this work will be very helpful for you to understand the process of the balancing out, right? Okay, so I think we need to make the first total liability, total liabilities plus total shareholders equity. So let's get started. So it must be total current asset plus total non-current asset. Okay, which one is now greater? Right, total asset, right? So in this case, we have to increase commercial paper, right? So now, which one? Which case? Okay, I think that one. Copy. Oh, okay, it's not working in that way. So here, oh, we first link the bigger one, right? First link the bigger one first. Then I want to use this formula. Hopefully this works. Okay, now it's this working. So now the commercial paper, they have like $30 billion, right? Any kind of short-term the borrowing tool is fine. Commercial paper, or instead of using the commercial paper, you can use just term debt. But usually this term debt is not the independently generate in the short term. Most of the term debt is the same, the nature of the term debt of the long term, but the maturity is now the shorter than 1 year. That's why I'm not using this term debt to balance out the total asset and total liability. Instead, just the short term, other short term, the financial, the instrument I used. Then we balanced out. The statement of cash flows is automatically generated, and then ending cash, 29 billion, and then 29 billion we balanced out, right? And 41 billion we balanced out, and then I didn't link anything, right? So it is separately the generated. Again, the cash flow statement is the byproduct once we complete this balance sheet, right? Period balance sheet, and then just the difference between these two period, right, is the base. So the statement cash flows generated, and then where you see the commercial paper here in financing, right? 9 billion and then 14 billion. They increased the commercial paper, right? And then short-term debt decreases, and then all these numbers is from the balance sheet and income statement we forecasted, right? And the comparative analysis ratio is the easiest the topics in finance or accounting. So I don't want to teach anything about this, the ratio part. Maybe some other courses already have dealt with these very easy topics, and then you can also use some further other additional ratios. So that's why in your report you need to use any kind of the additional ratios to analyze the company, right? I usually use this the financial ratios to justify my assumptions. It's not only to analyze their performance or the productivities or their leverages, but also if my assumptions is correct or not based on this the ratio analysis. That's why the investment report, this financial ratio analysis poses before valuation, before uh, uh, the before assumptions or after assumptions, right? We can use these financial ratios to make the forecast or to analyze the result. So that's why you have to go back and forth, back and forth. For example, asset receivable turnover is stagnant. Oh, is that right? The assumption that I wanted to see in the upcoming 4 quarters, or the quick ratios is increasing, right? Is that the right assumption that I want to see? Otherwise, you have to revise in this assumption, visiting this assumption table again. Or, oh, the inventory turnover is decreasing. Do you think it is really right to see the inventory turnover, their turnover decreases? Or your assumption is wrong, and then you need to revise this your assumption so that you can see the different result, right? Likewise, yeah, these financial ratios is used to analyze first your final result, but also you can use to revise your assumption and then go back and forth. Okay, so I hope you use this template well and revise the template uh, along with the different the name of accounts of your company, chosen company, and then put more data, more the assumption part as much as possible, so that you can get like more credit, the higher credits, right? Okay, so see you in the next video clips in a different topic. You guys, bye bye.